Joanne, I'm going to bring you into the conversation here. Obviously, a very big Fed meeting this week. It's been the talk of markets ever since then. How are you reading some of Jay Powell's message to the market, and then what's played out with equities, and what you think that means going into the following weeks?
Well, Courtney, investors really shouldn't have been surprised. As a portfolio manager and an economist, I was prepared for the Fed to increase its inflation forecast and to point to sooner increases in interest rates. I was a little bit surprised by the degree of the pullback in the market. And really, this is quite a different situation than we've experienced before on the cusp of a rate increase from the Fed. And the reason it's so different is because, yes, we do have inflation, right? We have shortages, prices are going up, but we also have this ongoing tailwind of reopening, not just in the United States, but globally. So when you look around for equities to hold, right, there are opportunities, some very attractive ones, both in the smart cyclicals, as I like to call them, but also in the secular growth names. And if you build into such a portfolio, which using individual stocks, you can get a lot of control, you can also build in some protection against some inflation risks, as well as a risk to other policy variables like tax rate increases. So, we view the equity markets as fairly attractive if you're selective. And while inflation and interest rates clearly are going to go up at some point, we think the market's really overreacted, particularly when it comes to the banks, which should see a strong tailwind as the cash runs out from the PPP programs and as households run through their savings. We're going to see those loan numbers come up. So it's always a good time to buy banks when the outlook for them is so negative as it is now.
Shepard Smith here. Thanks for watching CNBC on YouTube.